Hi everyone, I'm Yusu Dan Ren. Please call me Yusu. All my friends call me that. I'm the soon to be announced wholesaler for IDC Mississauga and Markham office. But you can please contact me whenever you need anything about Sun Life. I'm happy to start right away to help you. It's my pleasure today to introduce our speaker. Our speaker is Helen Chow. Helen has, we were just calculating her years of experience. So as a traditional actuarial role, as an actuarial analyst, Helen has been, 12.4 plus 2.8 plus 2.1 plus 1.8 years that we're talking about. So close to 18 years of experience. She was a regional sales director for 8 years and 10 months. And now in her current role, Helen is our AVP of Marketing Actuary. And she's been doing that for 3 years and 11 months. And your anniversary is on April 1st. Helen is brutally honest. She's a very fun personality, and I have to say, one of my favorite, if not my favorite person in Sun Life. So I'll give my mic to you, Helen.
Wow, what an introduction. Thanks, Yusu. So this is about Helen's models. When I spoke at the IDC event last month or so, it was like a shortened version. This is a little expanded. If you were there last time, I'll be repeating some of it, but also adding a little more details and also a few more models. But I first like to start off by just telling you, if you didn't see the announcement end of January, Sun Life is increasing its dividend rate on its par from 6% to 6.25 due to rising interest rates as well as strong real estate and equity performance we've experienced over the years. As well, we've also given out additional dividends to those who had policies issued prior to 2004. And I know people are often just concentrating on the actual dividend rate, which is tied to the investment portion of the dividends. But in addition, the dividends actually comprise of also a percentage of about 25 to 30% due to other factors such as mortality, lapses, expenses. So we've also updated those dividends as well. And as a result, you'll see that most clients will receive an increase. And when I asked the actuaries about most who did not get an increase, that was the smokers. So the smokers have poorer experience than anticipated, so their dividends may not be increasing. Now to go back to the Helen's models, as a wholesaler and also in my role now, what I did was over the years, I've been working with advisors such as yourselves, and I found that there were a lot of ideas out there, but we didn't know how to show it. So the reason for these models is to help tell the story in a simple manner. I know that often the strategies built by the insurance companies are 20 pages or so. They're built by the head office and it has to be approved by the risk and compliance. So clients and their centers of influence, the accountants, may be overwhelmed by all these numbers. So this is to help summarize them and then show it in a simple manner. As well, another reason why these models were built is that clients often have their own beliefs or misconceptions about insurance. So we're here to help address those hesitations about buying the insurance with numbers and pictures, such as the graphs. And then the third reason is that the main strategies the insurance companies show, which are typically the insurance strategy, corporate or personal, retirement strategy, or asset transfer. I've added some enhancements to those strategies, which have really resonated, particularly with the centers of influence, like the accountants. So I showed this quote from Richard Branson, who said that complexity is your enemy. Any fool can make something complicated, but it's actually hard to make something simple. And if you are interested, if you like this presentation, there is actually another one follow-up, which we call Twists on Corporate Strategies, because we see some advisors out there who are showing very complicated strategies, and I kind of help build them and then see if it works or not. So let's get right into it. Now, you may have come across the client who says, or their financial advisor who says that I can get a better return with equities. And the fact is that equities may be higher on average over the long term, but with it also comes higher volatility. So often when we are showing equity returns, we're going to assume that they earn 7-8% over every year consistently, but that's not the case. In reality is that when I show our par dividend rate and I show the maximum and minimum over the last 25 years, the dividend rate for Sun has only gone from a minimum of 6, which is last year and last couple of years. Today it's 6.25 and a maximum of 8.4, whereas the S&P ranged from minus 33% to plus 35% return. But when you look at the 25-year average, they're actually almost the same. And the S&P, we don't even factor in the MERs that may be attached to that. So the net may be actually less than 6%. But the important number is actually the volatility. How much does that fluctuate from year to year? And that higher the number means there's greater risk, greater volatility. So when you look at the dividend rate, it's less than 1% standard deviation, whereas when we look at equities, it's over 16%. Now, when I looked at the TSX S&P 500 total return, it's actually seen 8 negative years in the last 25 years. So about a third of those years were less than the 0% return. With par, the dividends are never negative. As well, we've paid dividends since 1877 every year. And once we paid out those dividends, we can't take it away from you. So what I've done is I built a model to show par, buying a par policy, putting the same amount, paying for the premiums, versus using that money to put into equities. You can either buy a term and invest the difference, or you can just put the entire amount into the equity. So in this example, it was putting $100,000 into a policy to buy par, and I ran it at current dividend, versus using that money to buy a T20 and then investing that difference into equities. And this time, I factor in the volatility of the equities so that in any given year, you're not getting 8% every year, but you're getting 8% on average over your lifetime. So it all depends on the sequence of returns, and there may be negative returns. So this is just one example of the yellow line is the par current dividend, which is always the same for all the scenarios, whereas the equity returns depends on what the returns are in any given year. So with that volatility, I built in a random generator, which randomly generates returns in the Excel tool so that from year to year, you'll get different results. So I've run a number of scenarios. So in this case, it was someone who was age 40, and at life expectancy, we assume 85. You can see that, the return was pretty close compared to the par. But then another example I ran here. So again, the yellow line is always the same of par at current dividend versus those different sequence of returns for equities. Then they were better off with the par. So I ran a number of scenarios. Here, the equity killed it. And then here's another one where the par was better. So we never know which way it's going to go with equities, where we have some certainty with the par because of the low standard deviation. And this low standard deviation is because we do smoothing within our par account. So we don't recognize those gains or losses every single year. So that over the long term, you are getting the same average, but from year to year, you don't see a drastic change in that dividend rate. And what I wanted to show you is that Capgemini has a World Wealth Report that they release every year. And in any given year, they show that the wealthy are actually putting in around 40 to 45% in what we call safe assets, which is cash or fixed income, because it's about preserving a certain amount of capital. Then the risk is taken with equities, real estate, and some alternative investments. So as they get older, you would think they actually would have more safe assets because they don't want that volatility. They want to be able to sleep at night. So what we show clients is that here's that Capgemini now in a pie chart instead of in a bar on your left. And let's allocate a portion of that fixed income into insurance, because insurance has the same volatility, that low volatility. So let's put about 10% of your total portfolio into safe assets instead of comparing it to equities. And in that, you can see that when you do compare our par dividend to long-term government bonds, that risk, the standard deviation, is even less than long-term government bonds, but has an average return that's about double over the last 25 years. Another statement we might hear from clients is that I don't want any risk, so this is for the older client. They can just live off the interest of their, say, GICs, and they can hold on to that portion of the capital to pass on to their heirs. Now, we've experienced record low interest rates over the last number of years, and interest rates are starting to go up. And what I want to show you is an insured annuity. Does it still make sense? How insured annuity works, for this example, is a male 65 who has $1 million. They can buy a 4% GIC. Now, right now we're experiencing an inverted yield curve. So if they can get 4 or 4.5 for a 2-3 year GIC, it's likely that after that period expires, the GIC may not be at the same or higher rate. It may likely be lower. Now, but we'll just assume that they can earn 4%. Now, with insured annuity, what they're doing is that they're using $1 million to buy an annuity for life. And this example, the $67,000 annuity income of only a portion of that is taxable, so that they net just over $59,000 in their pocket. Now, that $59,000 annual income, they're going to use a portion of that to buy $1 million life UL policy, min funded, that costs $31,000, so that when they die, their heirs will still get $1 million. And so in their pocket, they end up with just over $27,000 versus a GIC, which is taxed on its interest. So their net would be around $20,000 if we assume a tax rate of 50%. So they're only getting about $7,000, just over $7,000 more. So when you calculate the pre-tax yield, the GIC was 4%, and the insured annuity works out to just over 5.5%. That doesn't seem that great, because if I ran it a couple of years ago, GICs were around 2.5%, whereas the insured annuity was around 4.45. So it was almost double. Whereas today, it's only a 1.5% more difference. But another way we should look at this is, as I mentioned, that GIC rate is not guaranteed. So in this example, the insured annuity rate of 5.54% is guaranteed for this individual's lifetime. Now, if we had assumed that 4% they could earn, and they had to roll it over into a new GIC after 10 years, well, what would that new GIC need to earn to net them the same internal rate return in 20 years as that insured annuity, assuming this person is 65 with a life expectancy of 20 years, age 85? Well, that new GIC actually has to earn 7.56%. So if you think GIC rates are going to go up over 7.5% in 10 years, then don't buy that insured annuity. Another twist of the insured annuity is using that portion to that spendable income to buy some long-term care. Now, Sun Life is the only company left that has a long-term care product, which we call the Retirement Health Assist. We did stop selling our original staple product called the long-term care insurance. This one actually has a longer waiting period, 1 year, 2 year waiting period, as well as the effective date doesn't start for at least 5 years after the policy has been bought. But if they did pass away before the effective period, then Sun Life would return all the premiums they paid into the policy. Now, this with RHA, because of the longer waiting period and the effective date starting 5 years, it's much cheaper than our regular long-term care, as well as easier to qualify. So for this person, the male 65, he decides to buy $1,000 a week benefit, and it costs him just over about $2,300. So instead of having equivalent pre-tax of 5.54, it now reduces down to 5.03 because he's now buying the UL as well as the long-term care. So those are the premiums that cost him from $31,470 to just over $34,000. Now, if he were to go on claim, and he would get now $1,000 a week, which is an extra $52,000 in his pocket tax-free. So that's why you see the annual income go from 67 to 119. He still just pays a tax on the annuity. And in the insurance payment, he no longer has to pay the long-term care premiums. So then he's now only just paying the UL. So that in his pocket, he now has almost $80,000 to spend, and that works out to a pre-tax yield of almost 16%. Now, what this shows here is that RHA is actually the only product we have that does not guarantee the premiums. And that's a concern for individuals, especially when they're getting older. And they don't, and there's no cap on that RHA premium as well. But if they bought this insured annuity with RHA, well, how much would those RHA premiums have to go up by in order to net the same as that, remember the GIC of 4% pre-tax? Well, it'd have to go up 3 times, so an increase of 201% to still net the same as the GIC. So we do have a rethink on this. Rethink are these 2-3 page pieces that my area comes out with every couple months or so on ideas on what may resonate that you can work with your client they may be interested in. Now, another statement I've been hearing over the years is the client's accountant will say, we're doing pipeline planning, we won't be needing insurance. And the reason for that is that there's mainly 2 types of postmortem planning: loss carryback, which is how the corporate strategies are shown by all the insurance companies. It's been around since the 70s, approved by the Income Tax Act. And that results in one single tax being paid by the corporate owner at death, which is the shareholder dividend tax rate, which is around 47%. It ranges by province. And the reason why they're more interested in pipeline planning now is because you also are subject to one tax, but it's a capital gains tax, which is around 20% lower than that shareholder dividend tax rate. So it's around 27%. But the reality is that whether the accountant chooses to do loss carryback or pipeline planning, adding the insurance only improves the estate values. It doesn't mean they don't need insurance, just including the insurance enhances the estate values regardless of what type of pipeline postmortem planning you do. And we actually have a number of postmortem planning tools available. One of them here, this one accounts for, on the loss carryback, accounts for stop loss rules, meaning you can't, you will actually have to pay some capital gains tax and you can't eliminate it entirely. But all these strategies shown by the insurance companies do not take stop loss rules into account. But this model does. And what I've highlighted with the red around each number is that regardless of what type of pipeline loss carryback stop loss rules you do, if you had used that money and put it into an alternate investment, this is the pre-tax yield they need to earn on that alternate fixed investment in order to net them the same as the insurance at life expectancy. So you can see the numbers here range from 8.93 up to 12.55. So if you have a fixed interest investment that can earn you at least that, then insurance is not for you then. Another way to look at this is to compare 2 permanent life insurance products, whether it's PAR or UL. This is appropriate for the client who has no need for the cash values. They just want to maximize the net to estate to the beneficiaries out of their corporation. Now, in this example, it shows you loss carryback graph on the left and pipeline on the right. And then it shows you UL is in yellow and the PAR is in light blue, and the dark blue is the alternate investment, which earns 3%. So this shows you that if you're doing loss carryback, the around life expectancy, so this individual's 60 when they purchased it, the values are pretty close, but it looks like PAR is the winner if they decide to do loss carryback. But if they decide to do pipeline planning, then it looks to be that the UL is the clear winner in most all of the years. Another statement we may hear from clients is that insurance is an expense. They just want to minimize or pay it as little as possible, and that's where term insurance may be their best bet. But in reality, there actually are cases, as particularly our par with the early cash value, where it can have a positive impact to both the income statement and the balance sheet inside their corporation. So what we see here is that if they just bought a term policy, then it would cost them about $2,000 a year. So the impact will always be negative every year on their balance sheet and income statement. Now, however, if they were to buy the same amount with a par accumulator, which is our early cash value product, what they'll see is that in year one, the cash value is about 85% of the premium. And then the impact on the balance sheet becomes positive from year 5 onwards. What is the calculation of the impact on the balance sheet? It's taking the total cash value in that year minus all the premiums, the cumulative premium, total premiums they paid into the policy. So in year 5, the cash value is just over $265,000. Then if you subtract the $52,765 times 5 years, you'll end up with that $1,279. And then the impact on the income statement has to do with the change in the cash value from year to year. So that becomes positive from year 3 onwards. And how that number is calculated is that from year 2 to year 3, the cash value went from $95,560 to $148,748. The difference of that minus the premiums they paid into the policy will be that $423. So this was from a white paper that came out years ago and has proven to be quite popular with the accountants on how insurance can be positive on the income and balance sheet. Another way to look at this is the IRRs on the cash value. Now, the IRRs on the cash value becomes positive from year 5. So it becomes positive when it's positive impact on the balance sheet. They're tied to each other. So here you have a negative return for the first 4 years, then onwards it's positive and continue to grow. As well, another way is, so we looked at it on the pre-tax basis, calculate based on the pre-tax return, and the annual rate of return on the cash value is tied to when it's positive impact on the income statement. So here you can see from year 3, which showed to the previous example of the bolstering the balance sheet of it becoming positive on the income statement. And then we also show the after tax if they were to cancel their policy. So even if they had to cancel their policy due to some unfortunate reason, they would still get their money back and more if they can keep the policy in force for at least 6 years. And then here we show you the internal rate of return on the death benefit. So of course, the earlier they die, the greater the internal rate of return on that is. And we do have a rethink on this. So if you want to find any of our rethinks, they are at www.sunlife.ca/consulting. So if you go under professional insights, you'll see all the rethink pieces. And this will show you how the internal rate of return on the cash value is tied to the positive balance sheet impact, and how the income statement impact is tied to the annual rate of return on the cash surrender value. Next, sometimes we hear the statement, insurance isn't liquid. And what clients don't realize is actually there's a number of ways you can access the cash values inside your life insurance policy. There are mainly 4 ways. Policy withdrawal, a direct withdrawal, taking a policy loan, which is quite easy. They just fill in one form and the insurance companies will lend you up to the cash values in the policy, whether it's UL or par. With the policy loans at Sun Life, our loan rate is prime plus 2. So we used to have the lowest policy loan rate in the industry. And now because prime has gone up significantly, I think it's now 6.7%, the loan rate is now 8.7%. Another way is switching your dividends to cash. And I'll show you an example of that because we don't actually have something to illustrate that. And then number 4 is assigning the policy as collateral for a third-party loan. Either you do it immediately, which is what we call the IFA, the immediate financial arrangement, or if they do it later on, we call it the retirement strategy. Now, with the first 3, they may be subject to taxation, and all 3 can be illustrated in our software. With the 4th one, and I'll show you an example of what I've built in Excel next. And then next is that the retirement strategies is also available in our software. The IFAs must be run by your regional sales director. Now, what I built in here is that because in our software, you can take the dividends in cash, but it doesn't account in the calculation of the internal rate of return, those cash dividends you see. So if you took it in cash, it only takes the premiums you're putting into the policy, and then the death benefit that doesn't change because you're now taking the dividends in cash, then you'll see a much lower internal rate of return, which is not a true reflection of what it is because you are receiving cash and dividends. Now, since the 2017 tax changes, it has taken longer for the ACB to decrease to 0. But the benefit of that is that when you take the cash and dividends, as long as they're less than the ACB, then that entire amount can be received tax-free. So that's one of the benefits of the ACB taking longer to grind down. So here you'll see that in this example for a male 50, they started taking the dividends in cash after year 20. It was a guaranteed 20 pay. And then you see the previous year's ACB, they're taxed on that so that they're actually not paying any tax on the dividends they're receiving until age 85. So when I calculate that true IRR on the premiums going in, the net cash dividends after any tax if they have to pay for, and then the death benefit at death, then you can see at age 85, they should die around age 85 or 90. The net internal rate of return on that is actually still looks pretty good at 3.7 to 4%. And that's at current -1. So that's not another easier way to access income if your client doesn't want to go to the bank and get a third-party loan in retirement and have to worry about the loan rates changing. Another statement that the client may say is that they worry about the cost of care and their age, but when you look at long-term care insurance, it may be too expensive. But as I mentioned, Sun Life's retirement health assist is an affordable way to reduce their risk later in life should they need long-term care. Long-term care health costs have gone up. Inflation has gone up much more than regular inflation. And what we show you here is that we have a break-even tool. So although they may think it's expensive, here's an example of a male 65-year-old who signs up, who purchases $1,000 a weekly benefit. So as I mentioned, the policy doesn't kick in until 5 years later. It's actually the ladder of age 65 or 5 years. So here it doesn't start until age 70. I put in a waiting period of 2 years. So the premiums are just over $2,500. Now, if they were to claim, we can run different examples, but if they were to claim at say age 75, the benefits don't start till age 77. So they actually have to keep paying the premiums till age 77. So in that respect, at age 77, they've actually paid around $36,000 in premiums, and I actually added some interest to that. But if they went on claim, they get $52,000 a year. So they'll only have to be on claim for 8.4 months before they recoup the premiums they've paid into this retirement health assist. So with males, typically the break even is within 1 year, and for females, it's less than 2 years. because females tend to live longer as well as need long-term care more. And because RHA premiums are not guaranteed, we often just think that the premiums will only go up. Now, we did make some RHA premium changes at the beginning of this year. And what you see here is that, yes, they did go up at the younger ages, but we actually decreased rates at the older ages. And usually it's at the older ages that it makes more sense to purchase. Someone who's like 40, 45 years old is not going to be thinking about buying a long-term care product. So this is another rethink we have available on this, and it goes through example and the break even for both a male and a female. Now, this is an interesting one. It's called, and I don't see this too often, but if I buy, people think when they buy term insurance, majority of terms do not pay out because it's only for 10 years or 20 years, and it's not even close to their life expectancy. So they figure if I buy term insurance and I don't die during that coverage period, then I paid for nothing. But term insurance, the purpose of that is to prevent any kind of catastrophic risk of a premature death. And so it doesn't, but it actually, the premiums they pay has a very insignificant impact to one's savings. So how we look at this is about looking at the term premiums as an MER you're paying. So this model, what it shows you is that in yellow is if you never bought the term insurance and you put in money into your investments, and that's the growth of it, your investments over your lifetime up to life expectancy. But however, if you took a portion of that to buy a T20 in this example, then you have less to invest. So that's the purple line. But if you do die within those first 20 years, then the boost of the investments goes up by that solid blue area. And then the single red line you see decreasing is actually how much did that term premium you pay every year into it cost you in terms of your total investments. That's what we mean by term as an MER. And if you looked at life expectancy, it actually cost you about 15 basis points to pay for those the term insurance. Just a different way of looking at things. So we do have a rethink on that as well. Oops. A statement you may hear is that you have philanthropic clients and they get tax credits on their donations, which they typically get by donating after cash money. But they could be getting more bang for their buck by donating strategically, perhaps using life insurance. So what we show you here is that this individual is going to donate a min-funded UL policy for $1 million that costs just over $10,000 a year. Now, the insurance policy has attractive internal rate of returns on it. And the way we look at it is that should you donate that policy today and get the tax credit on the premiums you pay every year into the policy, or should you donate at death and wait for that tax credit on the death benefit? So we go into the pros and cons of both and how it impacts it. But what we also take into account in this tool is that do you have the income available to use the full tax credit? Because typically you would think that perhaps donating at death will get you most bang for your buck. However, do you have all the income available to even use the full amount of the tax credit based on that death benefit? So we allow you to enter that into the tool to then calculate how much you're eligible for, or you can actually use. And that is a rethink piece. Now, I've been hearing this more and more over the years, particularly during COVID, because we saw the increase of property values on the cottages. And many clients have these cottages they've had for years that they'd like to leave to their kids. But the reality is that will the kids be able to pay the capital gains on the tax on the cottage in order to keep the cottage? So sometimes we have clients that they realize they have to pay taxes upon death of the second parent, and they're okay with that, but the cottage is what they want to actually keep in the family. So we talk about the recreational property calculator because cottage is more of an Ontario term. We know out west they call it cabin, and Quebec they call it chalet. So it's the recreational property calculator. So this individual was a dad who was 60, surviving parent, and he had bought the cottage for $200,000, and today it's worth $1 million. So we'll use appreciation of about 5% a year. So what you see on the columns there is that the cottage market value is growing at 5% a year. And then we calculate the tax on that. So right now we have 50% capital inclusion rate. The marginal tax rate is over 50%, but we're going to say they are going to be paying around 25% capital gains tax on that. And I even incorporated a mortgage calculator in case they have some mortgage on the cottage that they would want to have that paid off as well if they should pass. So what you see here is that it'll add the two together, the capital gains tax and the outstanding mortgage, and then round it up to the nearest 10,000 to determine how much insurance is needed. So if dad is expected to live to 85, then we need about $800,000 of insurance to pay for the cottage capital gains. Now, another scenario is that in reality, the actual appreciation of cottages is closer to 7.5%, not 5%. And then there's been a lot of talk of the capital gains inclusion rate going up from 50 to 75%. So if we change the assumptions a little bit, instead of $800,000 insurance needed, it actually now bumps it up to $2.2 million of insurance. And another advisor actually said, you know what else should be included in there? The maintenance for the cottage, because perhaps you want to increase the insurance needed a little bit more so that they're able to cover the cost of any maintenance the cottage needs for the next 10 years or so. So maybe that 2.2 million can go up to maybe 2.3. And then from that model came the total portfolio tool, which we know that there are financial planning tools out there that can be used, but this one is very simplified that shows the current insurance the client has, and then all their assets, and we make some assumptions for the growth within the RSP, TFSA, non-registered, any other additional properties to come up with their total asset value, and then calculate how much insurance they need to pay the tax liability of death minus what they currently have for their current insurance. Very simple model, but this is just to give you a rough idea for the client on how much their tax liability will be. Statement. When it comes to universal life, I want absolute guarantees. Now, over the years, we've seen the cost of insurance on the level guarantee products go up, but UL's YRT is actually more affordable than ever. So I'm going to show you an example of that in that I'm just going to show the guaranteed 10-pay UL, but same idea for the guaranteed 15, 20, and the life pay, but it's more dramatic for the guaranteed 10-pay product. Whereas for each of these ages, pre-2010, we've seen almost 7 cost of insurance increases since then. I used to price UL and par, and in 2003, when interest rates were already starting to fall, Sun Life, we tried to increase the cost of insurance rates, only to find that the following year, we had to bring it back down because nobody followed. So it wasn't until 2010 when the market leader at that time, Manulife, they made the first increase to the cost of insurance, guaranteed cost of insurance rates. Then all the other carriers followed, and then followed by a second round, a third round, and then even a fourth round. We made increases due to the 2017 tax changes. We had to make increases due to COVID, and then some adjustments last year as well. So for a male 30-year-old, they've seen their cost of insurance more than double, and then less increases at the older ages because they have a shorter term to life expectancy to death, so that we don't have to guarantee it for that a lesser period. However, no one ever thinks about YRT rates. Now, if you look at term rates, T10, T15, T20, over the last 20 years, term rates have actually come down about 50%. And YRT is like a 1-year term. Why have they come down? Because they are not tied to interest rates. It's just based on mortality, and mortality, people only living longer. So when I look at our old products, we used to have something called a Clerica UL, and these are the YRT to 100 rates for a male 45-year-old. Then in 2006, we had a Sun UL YRT rate and the UL YRT 100, and you can see that the rates have come down. Now today, with a YRT 85, it's even lower, and the cost of insurance ends at age 85. So these YRT rates have come down significantly, and no one's even made the comparison. And that's why YRT today makes more sense than a guaranteed 10 product. So what I did was I looked to compare of all the key ages for a male 20, 30, 40, 50, 60, 70. I looked up how much for $1 million a guaranteed 10 pay costs. Then I took those 10 deposits and then I ran a YRT for all the other different ways of the cost insurance options and said, how much do I need to earn by overfunding it, and in order to net in the same deposits as that guaranteed 10 pay. So these are all the different rates of return that I needed to earn. And then I show which one requires a lower rate of return is the winner. So for those 20 to 55, the YRT 70, and then YRT 85 was the winner for 60 and 7. So for this example, what I found interesting is that for a male 60 and 70, if you solve for 10 deposits at 0%, it's cheaper than the guaranteed 10 pay, which is interesting. So you can, even if it earns 0, so that means that you're clearly better off doing the YRT 85 than the guaranteed 10 pay. And then I also show you here, like with our UL product, we actually have a fund called the SLDA, the Sun Life Diversified Account. And it is kind of mimics our PAR account in that it's a diversified account. It incorporates smoothing, has a guarantee to 0, and it's currently crediting 3.85%. So because of the smoothing, you should expect very little volatility. It has about 80% fixed income, where our PAR account has around 70, but it does still have like equities and real estate in it. Or if you compared it to the S&P of the 25-year average with MERs, then net of 2.2% is the average MER on an equity fund, then you would get around 5.75% on average return. So we can help solve for these hurdle rates. I built a hurdle rate calculator so that if you want to compare the guaranteed 10 pay versus a YRT, we can help solve for the hurdle rate so that you're not in the illustration running, do I need 2%? No, 2.2, 2.15, and you don't have to go back and forth on that. Then there's the enhancements I've made to the current strategies in the Sun Life software. We don't have budget to make all these enhancements directly into the software. So instead, I put them into an Excel tool. So this is what we call our corporate investment strategy. This is actually my most popular tool. And on the left-hand side, you have the alternate investment, putting in deposits, same amount as the insurance. However, what's different is there's a new column on the right-hand side called the required alternate investment rate to match the insurance. And what that does is solves for any given year, should that client pass away, what does the required fixed interest investment need to earn in order to net the same as the insurance? So this one has been really popular because we often just show the IRR, the net IRR, because insurance is mostly tax-free. But if I had to solve for what the pre-tax is, in this example, it was a joint last to die, and we're going to assume age 90 for the joint age. So in reality, they're probably around 95, but it still needs to earn 12.6% at the current dividend rate. So why is that interest rate so high when the IRR is only 5.3% net? Because on a fixed interest investment in the corporation, they're going to have to pay tax on the interest every year, and then have to pay tax again of the shareholder dividend tax rate when it comes out of the corp at death, net of RD2H. So that 12.6 is really a wake up, and these are the numbers that really resonate with the clients and their accountants. So I do have this tool available for both loss carryback and pipeline planning now, and it can compare whether it's PAR or UL as well. Now, with a retirement strategy, there are no graphs available. So this I thought was very useful because you can see that should they die at any given time, the retirement strategy far exceeds the alternate investment. And in this case, the alternate investment's earning 5%. So it shows you the total money they put in. So in this example, is 10 years of $75,055. And then it shows you the net income that they're taking over the years after retirement. So in this example, I think is around age 65. And then what they're left with after they paid off the loan. So retirement strategy netted them more than double than that of the alternate investment. Now, what's also different that I've added is that if it's a corporate retirement strategy, I also include excess CDA. So because after they've paid off the loan, typically that net amount is greater than the CDA, well, then there's actually leftover CDA that they can use to access other assets out of the corp. And so I calculate the tax savings on that and add it to the net to state to calculate the IRRs on that. As well, if your client has bought a PAR policy from years before Sun Life PAR policy, we've been getting more requests to see an in-force retirement strategy. So we now have models to show that for the client you showed, say 8 years ago, how things have changed with interest rates and how the dividend rate has changed. So we can use it in force and rerun that retirement strategy to compare to what you showed them at the time of sale. And then what's new is that I can even index the income. So when a client says that, okay, at age 65, I want to start taking out, say, $10,000, but I want to index that to inflation at, say, 3% a year, we can now show that instead of showing the same income being taken every year. Now, with the corporate asset transfer, similar to the corporate investment shelter, but you're starting with the initial balance. So the corporate asset transfer inside our illustration shows that, let's say you have $2 million and you're earning this much in interest a year. Well, if you allocated a portion of the $2 million, let's say $200,000 a year into insurance, then how do they compare? But with my model, I can now show the initial balance as well as new deposits coming into the corporation. And then if you want to transfer some money to the insurance, it doesn't have to be the same amount as that deposit. So it's a little more flexible. So in this example, if you looked at age 90 life expectancy, you can see that if they just left the $2 million and left $750,000 a year going into that traditional investment side of the corp, they'd have around just over 18 million at age 90. But if they included insurance, they'd have almost 38 million. So they have more than double for a strategy advantage of $19 million more. So we do have this available for loss carryback and pipeline planning as well. One more way to look at postmortem planning is that in moment of death, if you have your alternate fixed income asset and you did no planning, you'd be subject at the bottom. What we show you is that the alternate versus the insurance, and whether you did no planning, pipeline, or loss carryback, what is the effective tax rate you'd have to pay? So with the alternate, if you do no planning, you may be subject to both capital gains and shareholder dividend tax rates, net of the RD2H. And then with pipeline, you're subject to capital gains. So that's why it shows 25%. Here, the loss carryback is actually less than pipeline because of the RD2H. There was significant RD2H they were able to get back. With the PAR, with pipeline, you pay capital gains tax on the cash values. With loss carryback, you get a CDA credit where the bulk of it you can get out tax-free for that death benefit. So you can see the taxes paid on the insurance is much lower, resulting in much higher net to estate using the insurance than just leaving all that money in the fixed interest investment. So those are just a number of the examples of models I've created over the years, and that now all the regional sales directors have access to and can run themselves. They don't need me. So that kind of concludes the presentation for Helen's model. So I hope you enjoyed these figures. You can tell me how you found today's session by scanning this QR code just for a 2-minute poll to just give me any kind of feedback, or you can even tell me if there's any models you'd like to see me build over. And then if it makes sense, then maybe you'll see your model built and the numbers and see if we can prove it makes sense.
Lisa can post those up on WinBig. So Helen, if you can send those to Lisa, that'd be great.
Will do.
And she can post that presentation for you up on WinBig. You can download it from there and you'll have it in your hands in the next few days. So again, thanks a lot. We will be talking to Helen about some more presentations. That was just fantastic.
Thank you for having me.
Thanks. And thank you to you, Sue. Thank you.